Too Big to Fail, the inside story of how Wall Street and Washington fought to save the financial system, and themselves. Too Big to Fail is a nonfiction book written by American business journalist Andrew Ross Sorkin. The book tells about the global financial crisis in 2008 and the efforts made by government officials and financial industry leaders to fix a financial system that was on the verge of collapse. It provides an in-depth picture of the panic that ensued on Wall Street and Washington as the financial crisis erupted and how financial leaders and governments acted to address the problem. Sorkin also highlighted how the interaction between financial leaders and government takes place and how the relationship affects the decisions taken to resolve the crisis. It started with the housing market crisis in the United States, which then spread throughout the world. The book discusses how these irresponsible and crisis financial practices affected banks and large financial institutions such as Lehman Brothers, Merrill Lynch, Bear Stearns, and AIG, which were collectively deemed too big to fail. Government policies and actions can play an important role in preventing or exacerbating a financial crisis. For example, when Lehman Brothers filed for bankruptcy in 2008, the U.S. government decided not to provide financial support for the bank, even though they provided financial support for other banks at the time. This decision is considered one of the main causes of market panic in the broader financial crisis. This book discusses how such decisions exert a significant influence on financial markets and the economy as a whole. One of the main factors is the overly easy lending practices of financial institutions to consumers and companies, resulting in debts greater than their ability to pay them. This practice then triggers an increase in the value of property assets, giving rise to a higher demand for mortgage securities and related financial products. The investors are interested in investing in these financial products because they are considered profitable and safe. One of the factors that make this financial product look profitable is the increase in the value of property assets, which increases the demand for mortgage securities. This makes the price of mortgage securities increase and makes investors interested in investing. In addition, this financial product is also considered safe because it is guaranteed by property assets that are used as collateral in taking mortgage credit. The investors believe that if the borrower cannot repay the debt, they still have property assets that can be taken over and sold to return their investment. Since this financial instrument is too complex, investors do not fully understand the risks contained in it. For example, when investors buy mortgage securities, they consider that they are safe and make a fairly high profit, without considering the risk of default or default from the indebted party. In practice, complex financial products such as mortgage securities and related financial products are very difficult for many people, including experienced investors. This is due to many factors, such as the complex structure of the product, the vagueness of how the product is valued, as well as its non-transparency. When many people and companies began to default on their debts, the value of property assets fell and demand for related financial products dropped sharply. As a result, investors who buy mortgage securities incur massive losses as the value of their investments plummets. Overall, the financial crisis that occurred a few years ago was the result of interrelated factors, including too easy lending practices, an increase in the value of property assets, an increasing demand for related financial products, and the use of complex and difficult to understand financial instruments. In addition, the book also discusses the social and economic impacts of the financial crisis, including an increase in unemployment and a significant drop in house prices. Sorkin provides insight into how this crisis is affecting many people around the world and changing the way they view the global financial system. One of the impacts highlighted in the book is the increase in unemployment that occurs in many countries. When a crisis occurs, many large companies suffer massive losses and are forced to carry out terminations to keep costs down. This has an impact on the increase in the unemployment rate in various countries, which subsequently worsens the economic situation. In addition, the global financial crisis also caused a significant drop in house prices in several countries, especially in the United States. Many people are losing their homes because they can't afford to pay the higher mortgage installments. This has an impact on social stability and causes many people to lose confidence in the global financial system. The book became famous for providing an in-depth and detailed view of the 2008 financial crisis, as well as providing insight into the power and relationship between Wall Street and the U.S. government. The book also provides an understanding of the importance of strict financial regulation and the need for transparency in the financial industry. Based on this book, some solutions that can be taken to prevent similar financial crises from occurring in the future include: 1. Tighter regulation. The government needs to implement stricter regulations to oversee banking and financial activities, especially for oversized and complex banks. It aims to prevent irresponsible financial practices and minimize the risk of bankruptcy that could trigger a financial crisis. 2. Strengthening the role of regulatory agencies. Regulatory agencies, such as the Federal Reserve, should be given greater authority to oversee banking and financial activities and take preventive measures if a potential bankruptcy risk is found. 3. Improve risk management. Banks and financial institutions should improve their risk management in order to anticipate the risk of bankruptcy and avoid irresponsible financial practices. 4. Growing awareness of risk. Investors and consumers need to be given better awareness of their financial and investment risks. This can be done through better education and transparency in financial products. 5. Improving the international regulatory system. The financial crisis could have far-reaching impacts and have a global impact, so there needs to be international coordination and cooperation in overcoming the financial crisis and improving regulation in the financial sector. These are some of the solutions that can be taken to prevent future financial crises, as discussed in the book Too Big to Fail.